coming this morning. We've given you a policy letter that my colleagues here have been editing so that at one point I feared it might be shorter than the press release. But we've also given you a press release. With us this morning, to my immediate right, is Mr. Charles Delara, the Managing Director of the IIF, Mr. Hong Tran, who is the Deputy Managing Director and Councillor, and Mr. Philip Supple, who is the Deputy Managing Director and Chief Economist. We will be on the record. The focus is really this letter to leaders of the G20 summit. We, the IIF, publicly issued a letter to leaders prior to the April 2009 London G20 summit, which was a time when major decisions were taken. And since then we have done this prior to each of the G20 summits. So given the summit in Mexico next week, we thought we would do this today. Mr. Delara, perhaps you introduce the letter, and then we will, our colleague may add some comments, and we'll go straight to your questions. Thank you very much.
Thank you, Frank, and thank all of you for joining us here this morning. It's a understatement that the world is facing some very difficult times economically, financially, and I would even say socially and politically. The G20 summit, therefore, in Mexico next week looms very large, in my view, as a potential decisive point for global leaders to come together and develop coordinated actions to the problems which surround the global economy today. We're not in a global recession, we're still growing, but the risk of a global recession, once again, for the second time in 5 years, are very real. Obviously, some of those risks emanate from Europe today, but I think it's very important, before talking about the challenges and difficulties in Europe, to underscore that we need a globally coordinated set of economic policy responses by leaders in key economies around the world, including in this country, Japan, China, other key emerging markets, as well as Europe, if we're to turn around market sentiment and restore some momentum, global growth, and some confidence for investors around the world. We also need that coordinated approach to focus not only what each country can do individually, but how they can act in a coordinated fashion that sends a very clear signal that we, the leaders of the world economy, know where we're going, and we're going to go there together. This was done in London in the spring of 2009, and it was a turning point in market sentiment, as you recall. 6 or 7 months of market uncertainty, volatility, and dramatic collapse in global trade from the fall of 2008 after the Lehman collapse to the spring of 2009. We need, once again, a globally coordinated approach, not only to macroeconomic policy, but to regulatory policy. We have been on a path of regulatory reform, which in some respects is both necessary and sensible. Banks came into this last crisis, obviously, in general, undercapitalized, with inadequate amounts of liquidity, and with risk management standards that fell short, in some cases, of what was needed. We've come a long way since that time, though. The levels of capital in the banking systems, especially in the US and Europe, are much greater than they were just a few years ago. And at this stage, the risk is quite clear that the pendulum of regulatory reform, layer upon layer of new capital and liquidity requirements, along with many others, that pendulum has swung too far and is suppressing credit and thereby suppressing economic activity. The deleveraging process that we continue to see underway in Europe is a function of a lot of factors, not just regulatory reform, but it's hard to deny, no matter where you sit, that the increasing flow of regulatory requirements is part of that problem. A couple of additional thoughts on Europe in my opening comments, and then I'll be glad, along with my colleagues, Phil, to return to them as you may wish to direct your questions. First, let me welcome, as I do in the letter, the recent steps taken by the Eurozone to provide support for the Spanish savings bank sector. I think you're all quite aware that those banks at the heart of the Spanish banking system remain quite healthy, quite profitable, quite diversified in their assets and in their revenue. However, it's also very clear that the state bank, the savings banks that are at the periphery of the system, but nevertheless are not inconsequential, have difficulties. The efforts by the government to strengthen capital and unfortunately to require, in effect, de facto nationalization of Bankia was a sign of that a few weeks ago. But now we are pleased that the Eurozone has recognized the benefit of providing broader Eurozone support to bolstering the capital structure of the savings banks in Spain. That step has been taken. Details are being worked out. It's a positive step. And I should also note that this government has already taken a number of other steps, which can only be viewed as positive, constructive, and in some cases, courageous, tackling difficult labor reform requirements, which are essential for Spain to restore competitiveness. Moving forward on fiscal deficit reduction. If you look at what's happening in Europe today, however, the Spanish situation underscores a point that we've been making for some time that I think, frankly, is a challenge not only for the Eurozone leaders to meet in 2+ weeks, but it's a challenge for the G20. And that is that the efforts of individual economies under pressure, no matter how impressive, no matter how compelling, are unlikely to be sufficient to turn around market sentiment and stabilize their sovereign debt problems, respectively, without broader Eurozone action. That broader Eurozone action, the lines of necessity now are becoming increasingly clear. It is my hope, and I think it is the market's expectation, that soon Eurozone leaders will articulate a game plan with a timetable that shows us where Europe is going with regard to fiscal integration, with regard to some eventual destination, which I think many of us believe will be some degree of fiscal union. That path should also, in our view, be accompanied by a clear, specific articulation of what is meant by the broad notion of a banking union, a notion which has been debated and put into the marketplace numerous times by key officials in recent weeks. But I think it's clear, and we suggest in our letter, that one must articulate again a concrete game plan that revolves around the core issues of freedom of operation for financial institutions throughout the European Union, that revolves around a common approach to deposit insurance, that revolves around a common approach to banking resolution, and that may need to revolve around a common resolution fund. These are difficult issues, and we do not assume that answers can be found overnight, but we do know that markets look for a clear path and a clear timetable. And this will, I think, be a crucial challenge that hopefully can be advanced, not just at the Eurozone leader meetings in 2.5 weeks, but in Mexico next week. The path also, in our view, needs to reflect a more pragmatic approach toward finding the right balance between near-term fiscal adjustment and medium-term structural and fiscal reform. And right now, I'm doubtful that that balance has been found. In Spain, Greece, Portugal, and perhaps other countries, you see very focused, ambitious efforts to achieve near-term deficit reduction. The question that I think we need to contemplate is whether the focus on the near term is undermining growth more than it is facilitating deficit reduction, and whether a more blended focus on near-term steps, but at a more moderated pace, combined with more credible medium-term fundamental fiscal and structural reforms dealing with those tough nuts to crack, such as healthcare, retirement age, privatization possibilities and necessities, whether that approach isn't more compatible with what is needed. If you look at the pace of fiscal adjustment in Ireland, which has tended to be a more moderated pace of fiscal adjustment in spite of the much higher primary deficit compared to Spain, Portugal, and Greece today. If you look at that more moderated pace of fiscal adjustment in Ireland, you see something interesting. You see that it has helped build and restore their credibility in the markets. You see that when they set a realistic target and achieve it, that this actually gives confidence that they're going in the right direction. Spain's target this year is an over 3% deficit reduction, and that's nominal. That's not even taking account of the reality that Spain's economy is going to shrink this year. This is a broad point, which I think applies to the Greek program. It applies to Spain and Portugal. That there needs to be some reorientation here, because no amount of tax increases and spending cuts will stabilize that GDP and strengthen it and enhance it and reduce it unless you can get some serious growth going. And I think this is obviously the challenge that Europe faces today. One last point on global trade and finance. We've seen a growing fragmentation of the global financial structure, which is increasingly worrisome. It's spilling over into trade finance, it's spilling over into ring-fencing of assets in financial institutions, it's spilling over into idiosyncratic approaches toward regulatory reform. And it's very, very troublesome. The G20, the Financial Stability Board, and others have voiced their commitment to a globally consistent path of regulatory reform, but then they turn around and constantly deviate from that. It's time that they reaffirm that in those cabos and stay with it. And as long as we're talking about reaffirming the commitment and staying with it, let's talk about trade protectionism. In the 8 months alone, 7-8 months alone since the Cannes summit, 124 measures affecting over 1% of G20 imports, over 1%, just in that relatively brief period have been taken. Protectionist measures which fly in the face of the commitment that G20 leaders have made. Credibility matters in this world. And if the G20 wants to be credible, they're going to have to make statements and follow through on them. That is not my dictum. It is not a private sector dictum. It is a reality of the world in which we live in. One of the reasons why we underscore this connection between commitment and follow-through is because market expectations and anxieties are both very high. And our final recommendation to the G20 is get to work next week, make progress we in the private sector and you in the media and the markets all need to be realistic. Not all solutions are going to be found next week, but there needs to be a clear enough commitment to a broad direction of coordinated global policies affecting macro and regulatory policies in key countries. And it needs to have some quick follow-through. We're proposing, therefore, that they consider another G20 in September and ask the finance ministers to spend much of the summer with their teams working on concrete plans. This, in our view, would inject another element of confidence at a time that is sorely needed. Let me stop now and ask Hung and Phil if they would like to add a few points of emphasis or correction, and then we'll open it up to questions.
Phil? Other questions?
Yeah.
Okay, right. Any questions? Yes, let's go to the front. Well, we're waiting for Ian to catch his breath at the back.
Thank you.
Could you just introduce yourself? Sure.
My name is Christoph Eisenring. I'm lawyer at Zürcher Zeitung, Switzerland. I have two questions. The first, why should the banking union improve the situation in Spain when risks were concentrated in the smaller saving banks and the big international banks are quite healthy? That's my first question. The second question is a Swiss question. The Swiss National Bank has pushed Credit Suisse today to increase its capital cushion, and the markets were quite shocked about this and surprised. Is that the way how the SNB or the regulators should go? Was that the right approach to go in this case? Thank you.
Okay, great.
Hung and Phil, maybe you can each tackle Hung the first part, Phil the second part, and then I'll be glad to add anything if I can.
Yeah, I think the challenge is that, as Charles mentioned, the larger internationally active Swiss banks are, in our view, healthy and profitable. But Spanish bank, yeah.
And Swiss.
Spanish bank. But the problem has been all along in the savings bank sector, which are very much exposed to, on a concentrated way, to the domestic market, particularly property, housing, and property development markets in Spain, which is experiencing significant stress since the crisis. And therefore, the decision by the Eurogroup plus Spanish authorities to have this line of credit up to 100 billion euro to assist in the recapitalization of the Spanish savings sector, plus any buffer, in our view, is a good positive step. Not only the money, but also the conditionality attached to the bank assistance program to be monitored by the Troika, meaning significant and meaningful reform of the sector, governance, very objective and realistic evaluation of their balance sheets value through independent audit, and all of that, in our view, would be helping the sector to be restored to health going forward. So that is a positive move. On the question you have about the Swiss National Bank, basically this is another example of the topping up on of regulatory reform that Charles mentioned. The Swiss National Bank, as part of the review of the way banks calculate their risk-weighted assets, came to the conclusion that for their two international banks, might be using internal model might not be sufficient in terms of transparency to assure markets that they have sufficient capital. Therefore, they prefer these international banks to use more standardized approach in calculating their risk-weighted assets and therefore capital requirement. As a result of that thinking, they think in their financial stability report we released today that these banks need more capital. Basically, these are examples of the kind of national approaches to what should have been globally coordinated capital regime for banks. And I think that we should really stick to and focus to globally coordinated regulatory changes and not take the national approach. Thank you.
Yeah, if I can just add, obviously there's a specific bank involved, there's specific issues, and I'd like to make it a bit more general. I think what you've got here is another illustration
of a move that may sound kind of individually rational and nationally rational, but actually collectively it is very, frankly adds to the risk in the system, because if you get banking systems in the periphery of Europe, on the outside of the euro area, accelerating deleveraging, that's just going to intensify all these tensions that we've been highlighting. And you saw it actually 6 months ago when the UK announced, when the UK released its financials, the Bank of England released its financial stability report and said, look, the biggest risk facing UK banks is the euro area, and we would recommend further deleveraging. And it added a whole new twist to the euro area tension. So, as I say, moves that can sound prudent and sensible from a national regulator perspective, actually, I think, risk kind of adding to this kind of systemic downward spiral.
Let's go to the very back, to Ian, back, and then we'll come to Barry, and then maybe we'll go back. Ian, yes. Sorry, you were first up.
Thank you, Ian Talley, Dow Jones. I was just figured it was my waving my arms wildly. So, do you all take the view, Zelik's view, that the next several years the world economy markets are just going to lurch from one volatile moment to the next, or the perspective in the sense that Europe is going to just kind of patch and muddle through again, or that we're on the verge of the last chance to fix things in Europe before global financial calamity? And in light of that question, or maybe a third alternative, in light of that question, what is the lowest common denominator that is needed out of the G20 and the Eurozone before the end of June to assure markets once and for all? And is that lowest common denominator feasible politically, pragmatically?
Boy, you're loaded with tough questions, aren't you?
We're looking around to who should.
Ian, let me try to answer some of your questions. I mean, I hate it when I ask a question and someone answers by saying it all depends. But the answer to your first question does feel a little like that when you say, is the world economy going to lurch from crisis to crisis over the next few years? It really does depend on the quality of leadership and decisions that are made in the coming days and weeks. I do think many of you are too young to know a song called Last Exit to Brooklyn, which goes back into the 1960s, I think. But I do think that we are approaching a point where the lurch forward managed the crisis of the day and failed to clarify the path for the future. I do think we're rapidly approaching a point where that's no longer going to be acceptable. Europe has taken a number of useful, important steps over the last 2 years, and we can recite them, we can recount them. The creation of the ESFS alone, which didn't exist 2.5 years ago, the creation now of the ESF, the willingness to use it to backstop financial institutions in one country, the massive support for Greece, which facilitated and enabled us to do an historic debt restructuring, the support for Ireland, Spain, most recently in Portugal before. All of these are notable steps, but what has been lacking, obviously, is a compelling vision of where future is going in terms of its economic integration to address what is widely seen as a structurally flawed union, structurally flawed in the sense of monetary union, yes, fiscal union, question mark, banking union, or financial union, question mark. And I think the markets are looking increasingly to a clarification of what the end game is here. The first few years out of college, I was the navigator on a destroyer, and I sailed across the Atlantic about 10 times. And I would never have pulled up anchor on the East Coast of the U.S. without knowing exactly what my destination was. And then you set a course to get there, and it takes a while, two plus weeks. but at least you know where you're going. Europe absolutely needs to chart a course here and then articulate the details and the time path here if they are to move out of this lurch crisis to crisis mode. The common denominator, I think, that we're all looking for coming out of those Cabos is threefold, really. One, I think it is a clearer way forward regarding Europe, and I think although we need to be realistic and recognize that some of the details of that may not emerge until late June when the Eurozone leaders meet again, we need to see evidence of it coming out of those Cabos. Secondly, a broader recognition by the full G20 that they need to address issues in two paths. One is the IMF is likely going to have to play a more active role in supporting the European efforts. And the exact form that takes is unclear, but a bit of ingenuity and creativity may be needed here, because the IMF remains well positioned to play a supportive role. We sketch out an idea in here, for example, of the IMF coordinating a labor retraining fund, which is going to be necessary when you see the levels of unemployment that persist in Europe today. Secondly, individual policymakers, though, need to recognize before going to Cabos that the markets are not just looking for the European challenges to be addressed. They're looking for the challenges, and we touch upon this toward the tail end of our letter. They're looking for the challenges in the U.S., in China, in Japan, to be addressed as well. It's very obvious that what we have is a global slowdown and a global lack of investor confidence. Let me stop now and ask if my colleagues want to add anything.
If I can add quickly 2 points. One, the resolute and decisive action in April 2009 at the London G20 summit shows that G20 leaders are quite capable of rising to the occasion to do the right thing to restore market confidence if they perceive the risk of global recession and crisis is imminent. We suggest that right now the risk of those undesirable things is imminent, and therefore we call upon G20 leaders to do what they already did a few years back. Second point, and a concrete example, we think that monetary easing and accommodation is a very important component of a policy response, complementary to effort to restore fiscal stability in the medium term. But if central bank were to do it jointly together, then we think that the impact would be much more powerful than if they were to do that individually in a staggered fashion. We have seen in the past few weeks some individual central banks in Asia have done some easing, but not part of the overall coordinated move. We suggest at this point in time, such coordination will quickly have a market impact and can turn around market sentiment.
Lots of hands. Barry, and then we're going to go to the back, and then we're going to come over here. Thank you.
Barry Wood, RTHK in Hong Kong. Mr. Delara, in endorsing fiscal union and the timetable to address the structural flaws in the European Monetary Union, it's obvious that not all 17 countries would want, or at least I think it's obvious that not all 17 would want to move into a closer fiscal union. So if you had a situation where some did, and Ms. Merkel herself has spoken of a two-speed Europe possibility for those who want to go closer and those who don't. You said in the context of Greece leaving that if they left, it would be somewhere between catastrophic and Armageddon. If you had a two-speed Eurozone, would that similarly be between those extremes?
Well, I think, Barry, we're talking about two rather different phenomena. The debate over Greece has been focused on Greece exiting the Eurozone. And I think we all know that were this to happen, it would be not just disorderly, but hugely costly for the Greek people, the Greek economy, for Europe, and for the global economy. I think, obviously, it's a decision for the Eurozone leaders to decide whether or not they want to think about a two-speed two-zone Eurozone, so to speak. But my own view personally is that they crossed that bridge a little over a decade ago, and that they will need to decide to move forward collectively and subordinate. They're doing a good bit of subordination of private sector interests these days. Maybe they need to subordinate national sovereign interests. They're going to have to subordinate to a certain degree, and this is up to the political leaders to decide how to subordinate their national parochial interests to the better good of the Eurozone as a whole. And I think they're capable of it. I mean, 61 years is a long time to invest in something and then walk away from it. It's a long time. The roots of Eurozone integration and EU integration go deep into history, which we need not remind you of. But I think that the only credible and viable path forward at this point is a unified effort toward economic integration, including fiscal union.
Let's go to Stella, please. Here at the front. No, just here, and then we'll come back.
Thanks, Stella Dawson at Reuters. Two questions. One, you call for a larger role for the International Monetary Fund, and in your letter you also say that you would like to see them coordinate some use some precautionary facilities. Are you suggesting that it would be appropriate to extend precautionary credit lines to Spain and to Italy? And secondly, a little bit nerdy question. There's a mounting concern about the subsidiarity, namely that the the EU leaders may use their funds in Spain, but require that the governments be paid back before the private sector be paid back if the banks are to be folded. The European Parliament also has passed a resolution along those lines. Is that an issue that is deterring the private sector from holding government debt and adding to the Eurozone crisis?
Well, I think with regard to your first question, I think it's prudent for me not to specify where precautionary facilities could be used. What I would like to see, however, is a general signal from the management and board of the IMF that they're prepared to make available such facilities as needed. One could imagine that a line could be extended in principle or made available in principle to be utilized in collaboration with the Eurozone on a case-by-case, country-by-country basis as needed. The purpose being to demonstrate to the markets that there's a lot of firepower that's available here. I think it's not at all clear to me that either Spain or Italy need such facilities, but I think it's clear that markets remain exceptionally nervous, and that the IMF has substantial resources which could complement the rather limited resources that are available today. I think Poon said it's under 400 billion euro from the ESFS structure. On your second question, obviously this is a matter of concern, and I think that it's crucial, and it's not easy, for the legitimate interest of European taxpayers to be viewed in the long run and not just the short run. The desire of Eurozone leaders to give priority to their claims on other members of the Eurozone, while perhaps understandable and motivated by a short-term desire to protect taxpayer interests, may actually be counterproductive by discouraging and disincentivating those very private sector investors who are needed in the long run to alleviate the burden on the German and the Dutch and the Finnish, for example, taxpayers. Anything to add there?
Yeah, I think that the issue you raise is really of great concern to us, because not only the ESM treaty, which contains the provision that ESM loan will enjoy preferred creditor status, second only to that of the IMF, the action of the ECB, the national central banks of the Eurozone, and even the European investment banks exempting their holdings of Greek government bonds from the Greek debt exchange a few months ago. All of that sent a very clear and disturbing signals that private sector holders of the sovereign debt will be subordinated by official creditors. It is very unsettling. I think it has contributed to increasing the credit risk premium of many sovereign debt in the euro area, and because it is still unclear how it will work out. We think that it is a very bad idea because, one, it is retroactive. You have a group of countries deciding unilaterally to change the terms and conditions of existing bond contracts that have been out there for many years. And secondly, it is extraterritorial because a group of countries, again, unilaterally changing the terms and conditions of bond contracts acquired by global investors for many years on the basis of being senior creditors to the government and rank pari passu with any other senior creditors of those governments. So altogether, a bad idea.
On that, could you pass the mic just to Alex, and then we'll go just behind you.
Alex Rivero with the Brazilian newspaper Valor Econômico. You mentioned here some worries about a growing trend of imposing capital controls. But Brazil has announced today something in the other direction. So I'd like to know what's the point here. Do you see some protectionism here? My second question is, what do you expect from the emerging markets for this G20 meeting next week?
Yeah, I mean, I think the issue with capital controls, there are quite a few countries, not just Brazil, but quite a few countries that are kind of shifting their regime, in some cases to a more restrictive one, but in other cases actually to liberalize outflows to try and promote less upward pressure on the currency. I think one specific example, not so much of a capital control, but of a problem in the emerging markets that we would highlight is the Argentine government's actions to appropriate the assets of YPF, which is, let's face it, the assets of another G20 country. So it hardly reflects a coordinated environment of fostering international investment flows. But I think in this context, the emerging markets actually take on really quite a significant role, because if you look at the picture of global demand, it's really in the emerging markets where there's only any real chance of significant growth in the next couple of years. So we kind of we have been counting on the emerging markets to lead global demand, and we look for that process to continue. And that process can continue if the emerging markets continue to do the right policies, which I think is an acceptance of their new role in the world. That would include, for example, more monetary easing across the emerging world to reflect the fact that inflation is going back down again. We saw China ease recently, we've seen Brazil ease recently, we'll probably see India ease again in the near future. So this is quite encouraging. But I think emerging markets both have a larger role in the system and frankly probably need a larger voice. And that comes back to this whole issue of some of the institutional reforms needed at the G20 level. Again, let's not lose sight of the fact that this G20 meeting is taking place in Los Cabos, Mexico. I mean, if you think about where Mexico was 20 years ago, where it is today, both in absolute terms and relative standing, it's a pretty stunning set of developments, and a reminder that things, pretty bad conditions can get turned around over the medium term.
I'd just add one further point to what Phil said. I think each key emerging market, Brazil is certainly one, but there are many others, including Mexico, China, India, Indonesia, Turkey, needs to look at its own circumstance and say, what can we do in the fiscal, monetary, or structural space to enhance our growth potential? As I think about Brazil, I think about one of the first things that comes to my mind is not just near-term macro issues, which Phil alluded to, but labor market reform, trade liberalization. The emerging markets deserve a bigger voice, but they need to recognize that with it comes a greater responsibility for the global economy. And maybe, unfortunately, it's going to be necessary for emerging markets to lead the next wave of trade liberalization, because I'm not confident that G7 has it in it. I'm not. And if we come back again in 6 months and we have another 124 trade protectionist measures, which have taken another 1% of global trade out of the free trade zone, I think we're all in trouble.
Could you pass the mic just behind you? Thank you so much. Thanks. Thanks.
Hi there, it's James Twiggy with the Financial Times. I was wondering if you could clarify on the Fed. Are you calling for further easing at its meeting next week, preferably in coordination with other central banks? And what form should that easing take?
Well, yeah, I think it's reasonable to think that the Fed should be.
No, go on. I just couldn't hear your mic.
So it's reasonable to think the Fed needs to be easing further in the context of a world that's not just softened but risks softening further. Now, of course, if the Fed does it alone, then you probably end up with the dollar going down against the euro in particular, and euro appreciation is probably the last thing that the euro area needs. So the ECB, probably being realistic here, needs to act more decisively than the Fed, I think. And it's a real shame, I think, that the ECB, it's kind of stunning in a way that the ECB passed on easing at his policy meeting last week. I mean, if you kind of take a step back and think of the discussion they might have had around the table, there's so many things going wrong in Europe, and inflation was coming down, and they sat there and did nothing. We know that monetary policy works with a lag, so if you want to see the European economy improving in the third quarter, I'd have thought now is the time for monetary policy action to be taken. So, I mean, as Charles emphasised, these things tend to work much better when they're coordinated. And so a coordinated move, I think, could be very constructive to building a commitment to the restoration of growth.
I would just underscore his point that I think your question was understandably focused on the Fed, but this is a ripe opportunity for coordinated easing by some of the world's key central banks, and perhaps not just industrial country. I'd love to see 4 or 5 central banks simultaneously move. And I think that the conditions for that obviously need to be justified within a domestic context. But the global benefits could be substantial, because markets do notice the difference, the huge difference between coordinated and independent actions. I worked at the Treasury for 15 years, and I tried to help manage exchange rate policy, and we could throw $500 million in the foreign exchange markets to try to strengthen or weaken the dollar on one day and accomplish very little. We could turn around the next week and throw $200 million in and accomplish a lot because we coordinated with Germany and Japan. Obviously, foreign exchange policy is different than monetary policy, but I think the world is in serious need of a positive confidence shock. We've had too many negative ones over the last year and a half or so, and I think that the time is nigh for something along these lines.
Any more questions? We need one on Greece. Please. Please, let's go there, and then we'll go back of the room. But first, let's go here. Let's get the mic. Can we just get the mic? I'm so sorry. Thank you.
My name is Vesna Siriopoulou. I'm from the Greek newspaper Ependidis. I have 2 questions. The first is about the new Greek. You say here that the new Greek government has to reaffirm its commitment to the central tenants. The central, do you think that there should be, or there is more space, there is space for changes? Otherwise, the program, the reform program, is not going to work?
Well, 2-part answer perhaps to that. We emphasized the need for a new government to reaffirm its commitments to the central tenants, because those tenets of strengthening the competitiveness of the Greek economy, of downsizing the scale of government, of privatizing, of advancing further in in crucial areas such as medium-term fiscal reform and revenue collection. All of those are driven not fundamentally by the Troika and the Troika negotiations, but they're driven fundamentally by the realities of the global economy and the needs for Greek citizens to have the opportunities that they deserve, and the only way they're going to have those opportunities is with a much more liberalized and competitive economy. Here I'm putting on my economist hat and not a political or banker hat. I would also say that is there room and need for change, or is there room for change? I think you asked. The answer is yes. We specifically, and Hong and I and many of us have been very intimately involved in the Greek economy through the private sector voluntary negotiations, which produced, as you know, this unprecedented debt relief for Greece. But for Greece to seize the opportunity provided by that, they need not only to follow through on the reforms, but to, I think, have a realistic pace of near-term budget reduction. And I think 11% on a cyclically adjusted basis over a 2-year period is just too much to ask of any economy. And it's taken too much wind out of the sails of the Greek economy at a time when investor confidence has exogenously declined. I think a more, if I may say, a more of an Irish pace of fiscal reform here than the earlier pace. And we saw it over the course of the second half of 2011 in the early part of 2012, when the program began to fall short of near-term budget goals, in part because of the unexpected weakness of the economy. The decisions at that time, perhaps understandable, of the Troika and the Greek authorities to take another slice of spending out of the economy may not have been, in my view, particularly well placed to deal with either long-term issues of debt sustainability or short-term issues of stabilizing the budgetary picture. These are difficult judgments to make in any case, and in Greece it's been particularly difficult. But I would hope that European authorities, if a new Greek government reaffirms its commitment to those fundamental tenets of reform, which I believe are essential for the future of Greek competitiveness of Greek employment opportunities, then I would hope that Eurozone leaders would have the farsightedness to recognize the benefits of some adaptations, particularly of near-term budgetary goals, but also perhaps of the repayment terms of some of the official lending, which I think probably should be reviewed and reconsidered in terms of stretching out some of the maturity payments.
Let's take two quick more questions on Greece. You've got a follow-up, and your colleague has a question. Oh, you didn't have a follow-up? I thought you did. Let's take these together, and then we'll go for one final question in the back of the room.
I want you to explain more about the modest additional financial support.
For Greece. Okay, 1 second. You had a question?
Yes, I have a question on Greece. Mr. Dallara, you know Greece now, after all these negotiations. Do you really believe that Greece can be saved?
Short question, short answer.
I think I'll answer the first question first. Modest additional financing. I think it's important to recognize how far Greece has already come in its adjustment efforts. Huge fiscal adjustment. Major pension reform. Early days of privatization, admittedly. Initial efforts to strengthen revenue collection. Private sector wage adjustments, which have restored almost half of the competitiveness loss that Greece experienced in the first decade of this century. So I think that if Europe is required to consider an additional, for example, and I think these are very approximate numbers, 10 to 20 billion euro over the next couple of years to facilitate a somewhat more realistic path of a near-term budget adjustment. I would hope that that could be a real possibility. Do I believe Greece can be saved? Absolutely. So much has already gone into the rebuilding of the Greek economy. It is unfinished business anytime you're trying to re-engineer the fundamental structure of an economy, and that's what Greece needs to do. It's long-term. When you look at the protected sectors, when you look at the labor laws, when you look at the extent to which it is so difficult for new job entrants or entrepreneurs to break their way into various fields in Greece, when you look at the underlying weight of government spending on the private sector, this is long-term. But I see a country that has invested more than is generally recognized in its future already. What I don't see, and the private sector, I must say, has invested in it as well. Mistakes were made, loans were made that were not properly understood from a risk management point of view. And to their credit, if I may say, bankers and investors recognize the reality of their mistakes and have given Greece a huge window of opportunity with €100 billion debt reduction, debt elimination exercise. And the new claims we have on Greece do not even begin to come due for a decade. So there's a lot of investment already in Greece's future, and I think in order for the fruits of that labor to be realized, some additional labor is needed on the part of Greece and on the part of Europe and on the part of the global community, in which case confidence can reemerge. Investment can return. And by the way, I should mention that the recapitalization of Greek banks, which has already begun, is going to be a crucial element in turning things around. Greece has a credible economic future, and they're already moving down the path of it, and I think that additional efforts now will make a lot of difference.
Let's go to the final question, which was at the back. I think Sudip really put his hand up, and then we'll wrap up.
Sudip Gray with the Wall Street Journal. So hoping you could just take a quick step back. A year ago, you were getting into a lot of the talk and debate about a Greek restructuring. First, given how far we've come, how has that been used? At least however Europe has used it since they pushed so hard to get the Greek restructuring as the solution to that problem. And more broadly, this has led to obviously a lot of persistent chatter about the need for restructuring of other sovereigns in Europe. What's your reaction as you hear all of that and as the volume of some of those calls?
Well, obviously the Greek restructuring Sudan was a very difficult, complex, extended, and occasionally painful exercise, but it is done. It was executed fully in March. Voluntary participation in it, as you know, is in the range of 97%. We, I think, have yet, however, to see the fruits of this labor because of the continuous uncertainties which surround the future of the Greek economy and the necessary political process which we all need to allow to run its course. We have to show some patience and respect the right of the Greek people to choose their next group of leaders and to go forward under that leadership. In the end of the day, I feel quite comfortable and confident that the restructuring which was agreed, complemented and supported by crucial additional support from Europe, by the way, and that restructuring would not have been possible without the 30 billion euro loan to Greece, which was used to enable the private creditors to at least take some cash out of this deal. It would not have been feasible without the incremental support of commitment of up to 100 billion euro beyond that 30 billion. All of those steps, I think, have positioned Greece to move into a phase of reform and a restoration of confidence. And I think the fact that we haven't seen the benefits of that yet just demonstrate that we need more confidence, we need more clarity, but we also need a solution at the Eurozone level. I mentioned earlier on that the efforts of Spain, well-intended and well-designed on the whole, the efforts of Portugal, Italy, Ireland, Greece, they all need, I think, a clearer path European economic and fiscal integration. And I think reinforced with the measures on the ground in Greece, a lot can change in Greece over the next 18 months. I don't see, I've spent a lot of time recently in some of the other challenged countries of Europe, Ireland, Spain, Italy among them, and I don't see another case that is even remotely close to Greece in terms of needing the sovereign debt restructuring that Greece needed. You look at Spain, even with this incremental dose of government debt that comes through the recapitalization of the banks, their debt to GDP remains quite manageable. Italy obviously has a somewhat higher debt GDP, but they're making significant progress on structural reform, labor market reform, deficit reduction. Ireland has made huge progress. I don't think I've visited any country in Europe in the last year where I have come away with such a sense that they're just about ready to turn the corner as I did in Ireland. So I don't see, fortunately, thank goodness for all of us, another Greece on the horizon in terms of sovereign debt restructuring.
Yes, Mr. Son.
I'll just make a last point here. You asked, can Greece survive? Can they make it? I think the answer is simple. You just have to beat Russia in your next game.
That was for all the soccer fans. Okay, on that note, thank you very much indeed. Thank you.
Τα πήρα όλα.
Yep.